Good day, everybody. It's Greg Schnell, and I am here with the weekly market roundup for February 22nd, 2019. A big week in the markets. World markets had a good week. Currencies are still my biggest focus. I haven't got a direction yet, and I'm continuing to watch. But commodities had a superb week, and we had big moves with steel, lithium, rare earth metals, solar. Great stuff going on in those areas, and not so much in the oils and precious metals, but there were still stocks breaking out to new highs in those areas. So still some good things going on. We'll go through the sectors here in just a bit, but again, another bullish week and lots of breadth signaling a big bull market here. So let's get into the world markets first. Just topping it off, you can see Shanghai was up 5% this week, Hong Kong up 3%. And Japan was a chart I've been worried about for a while here, and I'm just going to open this in a new tab. The problem I have on the Japanese chart is this PPO is trying to move higher here, and if it was to roll over well under zero, this would be a big problem. And so watching closely, but it was nice to see it have a good positive week. Now, once it kind of broke out, it didn't do anything. But one of the reasons I was nervous was this full stochastic on a weekly chart looked like it was going to roll over. And so we need this to kind of, if it was just going to pause here, that's one thing, but it does need to finish going to the upside. And again, if the Japanese market is going to make new 52-week lows, usually that's not helpful. In relative strength, make new 52-week lows. So that's one of the things that I'm cautious about, and we'll continue to wait for that to evolve. So getting back into the rest of the markets, Russia, Mexico, Australia, commodity markets, and they all had big up weeks. South Korea got going, and that one's been concerning for a while. Even Germany had a good week. And again, 2 weeks ago, it really pulled back hard. So we had weak PMIs in Europe, and yet Germany still was able to rally, and so was France. So I think that was good. The Canadian market outperformed the U.S. market slightly. We were up 1.1%, and the S&P was up 0.6%. The Dow was up 0.5%, and the NASDAQ was up 0.5%. So perhaps the rally's running out of steam, but I still think, if you're watching for breakouts, there's still some strong stocks that are ready to start to move. Looking at Brazil, that one has been a powerhouse, and it really just was kind of one of the weaker ones of the week. But India, again, this India chart is a little bit troublesome, but not really that problematic. We just need to see it start to accelerate again. This relative strength drop off in India with all of their what's the word I'm looking for? Demographics. With all of their good demographics, if this can start to break out, this would be very helpful. I don't like it when I see a big global leader like India not performing. So we do have this problem of a left shoulder ahead, and then on this right shoulder, you keep trying and trying and trying, and then all of a sudden it just literally collapses down here. And if you get that collapse down, that would be one to worry about. So let's call it 35,000 on the India exchange. If it can hold that level, we probably have to worry a little bit more. I just want to go back and look at some of the other markets. Let's check in on the commodities. In general, look at how big these were. Copper related were up 5%, so that was huge. And the copper miners also had a great week. There were some nice breakouts in that whole area. Canadian crude tacked on another 5% to the 10% it was up last week. Natural gas is trying to bounce off the 260, or let's call it 260 level, which is where it's set up a base over the last couple of years. So we continue to watch down around that range for a bottoming cycle and starting to turn back up. Rare earth metals, a beautiful week, up 4%, and lithium and steel both up big. So with that kind of a move, very happy to see the market response. Silver miners and gold miners, another good strong week. The ag sector wasn't as good. Sugar has one of the nicer charts. It's breaking a big 2-year downtrend. Crude was still up a little, but the energy-related stocks in the U.S. Weren't up as much. They were down actually slightly on the week. So perhaps crude is ending its run here. Marijuana names are up slightly, but I'm still continuing to worry about the shape of the momentum chart on that graph or on that chart. And when it rolls over, I think that'll roll over hard. So just for those in that space, be very aware of how tentative the situation is. Okay, getting into the... Is this the one? I think I need one more, sorry. Getting into the U.S. sectors, utilities was the strongest one for the week, so that's not great. Materials were really positive, and I mentioned that was on the back of copper. Semiconductor still continues to improve. Look at how nice that chart is. Just keeps climbing, and so this has been a real big move. We're starting to see the MACD get up to the top here and roll over. So that's a bit of a concern. But at this point, it still looks like it wants to climb. So that's not that big of a problem. Okay, getting back into my list here. So technology and discretionary were up nicely. We did have healthcare pause, retail pause, energy pause. So from that perspective, it wasn't that great. And financials didn't do anything. They were just flat on the week. The good news was Staples wasn't also at the top of the list with utilities, but let's keep watching with utilities being the leadership for the week. It makes you wonder if we're going to continue our big growth spurt here with utilities there. Okay, let's get into my chart here, and I lost it now, sorry. I recorded this all once and then forgot to have the microphone on, so my charts aren't set up the way I'd like them. Anyway, here we are with the advanced decline line. And what we see on the advanced decline line, it continues to push up here above the November highs, and price is right at November highs, so usually it's positive when the advanced decline is leading price. So that's good to see. Now, the other thing that we've got is this huge momentum in the advanced decline ratio. And when we see that pushing up, this is usually associated with very bullish situations. So just looking back over multiple years, these big wide thrusts, if you just look through and look for big wide thrusts starting after deep pullbacks, that's the kind of thing you want to see, is these strong breadth indications. And look at how big this one has been. An absolute rocket out of the gate. So that bodes pretty well for us. And the same sort of thing we saw in 2016. So liking what we're seeing there, that's for sure. From the high lows, the NASDAQ is starting to break up above this 100 level. And you can see that was typically how the bull markets get started in both 2009. 2011 and then 2016, when we push above, after being way below for a period of time, all of a sudden we start to get net new highs accelerating. That's very bullish. So we're right on the edge of that right now. I want to see it keep going, but that looks pretty good. For the New York market, what we see here is, again, the same surge in advanced decline using an 11-period moving average. So this big, strong positivity. Nice to see. And again, the advanced decline line hit new highs before price did. And usually that's a very positive setup when we get that. So we like that. The high lows, this one's also been breaking out. So this one actually did get above this 100 level, and it's even above the highs from last year. So this is definitely the first week in a year. So new 52-week highs in the high-low indicator, which measures 52-week highs. The difference between stocks making 52-week highs and 52-week lows, that difference is what this chart records every week. And here we are this week having way more net new highs than we've had going back for the last year. That's usually how bull markets get started. So like to see that. That was a very exciting stat to start showing up on the pages. Here is the Canadian advanced decline line, and we see the same thing with this big, huge surge. We got this in 2016, and it's that kind of thrust that we want to see. Just even looking at the chart here as it goes up, you'll notice you can have a few down days or whatever in the advanced decline where the moving average kind of drops down. But in general, you're in a big uptrend. And what happens is when you finally lose that uptrend and you actually start to stay down there, that's when you really get problems. So anyway, that chart looked pretty darn good. The high lows for Canada, above zero is bullish for Canada, but what you can see is that we're not really as bullish as we were back in 2016, and the US charts are already starting to get there. We want to see those Canadian charts start to perk up. Okay, the McClellan oscillator, and the point I want to make on this chart, the McClellan summation index is way up here at 1252, and you can see that's even above the 2016 initial thrust highs. And looking down here on the McClellan oscillator, it's been holding above zero so far. And if we just go back to these same sorts of periods in here, you know, after we started to lose our thrust and our McClellan oscillator came back down around zero, we chopped around for a little bit. So I don't know if that's what we're heading into, but if the McClellan oscillator starts to go below zero, we're probably at least pausing for a little bit. Doesn't mean slamming down hard. It just means we might pause. From the summation index, which was what I showed you on the last graph right up at the top here, this summation index, this is just a line graph of it. This next one is using candlesticks for it, and it's either up big or down big on the week. And what we're looking for here, I just want to draw a line at 1252. Not minus, positive would be better. And on this line, what you see is when we're way up at these levels, I'm just going to take it back a little bit further. When we're way up at these levels, you know, this is the kind of initiation thrust you get off lows. And when it comes out here, this is very strong. And even during this pullback in the summation index for all the way into, I'll call it June or July, as this pulled back, look at the market. It paused in that period, but it just kept going higher after that. In 2009, we rallied off the lows and got up to these kind of extreme levels. And again, we had some pullbacks in here for a little bit, but these were extreme and they just kept soaring. So when you see this kind of market breadth, it's hard to argue that the market doesn't want to go higher. Here we are in 2012 getting it, and this breadth came up, and you'll see it's quite close to this line up here. Over here, the top was quite a bit later, like almost 3 months later. So don't, just because it starts to pull back, don't immediately think we're going to go lower. For the NASDAQ, same thing. This thing is way up here, screaming up near the top. This goes back to 2006, and you can see the 2009, 2010, 2012, 2013. And again, this 2013 is quantitative easing unlimited, and that really gave the market a big bull market thrust and smoothed out the volatility, and it was pretty much a straight arrow. I'm not sure I want to match today's environment with the quantitative easing unlimited, or I think it was called Infinity, QE Infinity at the time. But here we are with lots of breadth thrust, and again, if we pulled back a little bit, the chart can still go higher. So don't use those as sell signals just because they're way up in the sky. For the bullish percent index, you know, these charts still have a downtrend on them, and that's somewhat concerning. Back here in 2008, they had the same sort of thing. I think the bigger point here is all of the percentage of stocks are back above the 200-day moving average. The percentage of stocks on a buy signal starting to get back up to the level. Like in 2008, we never got anywhere near this level. In 2016 and 15, we were lower than this. And so as we start to push up here, this feels pretty good and more like we're in a new bull market. If it rolled over tomorrow, just to pick an example, I still think the strong stocks would take a while to sell off, but the weak stocks would be the ones that would start to give us a clue. The NASDAQ 100 actually dropped, one bullish percent index, and one stock fell back down off a buy signal. And for the percentage of stocks above the 200-day moving average, this pulled back slightly as well. So that's not huge just because 1 week pulls back, but it does suggest that the upside momentum may be finally waning after weeks and weeks of climbing. The bullish percent index for the New York Composite, which somehow I find it to be a more clean reading, not quite as volatile, is up around 60%. That's very strong. And we're almost 60% of the stocks are on are above their 200-day moving average. So both of those hitting these 60% levels, pretty darn enthusiastic about keeping this run going with that much breadth. It's when breadth stalls in the 40s or something like that that would be a bigger problem. So here's the S&P up around 72%, and the percentage of stocks above the 200-day at 64%. Those are both really strong numbers. And again, with the S&P, just the big 500 stocks at 65%, this is really a good, strong area for us to have a bigger advance from. You'll notice these big rallies from this oversold level up into these levels. You might pause here, but then you continue on and you just have another surge where everything starts to join the party. Not sure we get that. We just don't know. But my main perspective here would be, the market is definitely trying to rally here, and I wouldn't, let stops take you out, but don't, I wouldn't go outright short here. There's just too much breadth. For the Canadian market, we don't have the screaming buy signal we have in the US yet. We're at 54%, and you can just see back in 2008, this was kind of the level where we rolled over at, but we are much more bullish on the percentage of stocks above the 200-day moving average. Lots better than in 2008. So I'm impressed by that. I'm a little concerned that these downtrends are still intact here for the momentum indicators or sentiment indicators. Looking at bullish percent index for energy, some of the energy stuff rolled over this week a little bit, and you can see the XOP trying to get through the January highs and hasn't been able to yet. Same thing for the oil services group. The charts in general are set up nice. The bullish percent index keeps climbing, and so does crude oil, and so does the XLE in general, but that includes solar and wind and a whole bunch of other nuclear energy. So there's other things in here. Whereas XOP is oil, and same with oil services. So they haven't broken out yet, and as long as they're above the 50, you probably want to try and own them long. 50-day moving average. Here's the bullish percent index chart that we keep track of momentum on down here with the MACD. And what we see is when this is surging up, you probably want to be part of the exploration and production ETF. It does a pretty good job of climbing. So here we've had this recent pullback, and now we're trying to rally up. If it does start to break down in here, then perhaps you might have to worry about things going lower again. But I must admit the chart shapes on a lot of these look pretty good. So if it took a week off, I'm not sure that that's a real problem yet. The gold chart just continues up and to the right with everything else following. So when we get to the GDX GLD chart, that's one of the ones that makes us a little bit more cautious. Let's just call it that. Options expiration, we really haven't done much since then. On the Zoom panel, it looks a little bit more. We closed 27.75 and we're at 27.92. So pretty nice move up a little bit, but on the big picture chart, it doesn't look like that much. It looks like we've consolidated after the after options expiration, and the same thing for the NASDAQ 100, up slightly, but again, from the just looking at the 200-day moving average, we're pretty much where we were a week ago. And that's the S&P 500 chart in the foreground, and in the background is the US dollar. And these are the Fed meeting dates. We don't have one until mid-March, so we've still got 2 or 3 weeks before that next meeting. Monthly performance has been huge. We are up 5.84% from 20 days ago, so that one is a big one. And we are up 11.4% since since the year started. And if we just move this back to 2018, 12/24. For the rally off the closing level of December 21st, big push up here to 1556. So lots going on. Market's been in a huge uptrend, and until that breaks, I think we just have to stay with it, but it hasn't given us any sign of that yet. Looking at the NASDAQ 100, I think this is one chart to just remain focused on. A lot of people are talking about the on-balance volume hitting new highs, advanced decline hitting new highs, accumulation distribution hitting new highs. I will say that when they were doing this in September, October, they were still pushing up nicely. There was no real problems there. It just wasn't that much of a clue. It didn't help us. So I would just say that on the markets in general, they're looking good. From a big perspective, just a big picture perspective, one of the concerns I have is, you've got this bump, then you have a lower low and a big run up into this, and then you're back smack dab into the middle of an area where you might expect resistance. So that's one thing that would make me pause for caution here, just from a big picture, standing back, looking at it, don't have all the internals. But from the breadth perspective and everything else, it does look very bullish here. Okay, New York Composite bouncing back up, and it's back above its 10-month moving average, so that's also a positive. This is zooming in on that same chart, and you can see we had a downslope 10-month moving average here, and all of a sudden it's already turned to an upslope. We still have a week left before that'll finalize, because this green line is based on the closing prices of each month. But so far, we're back up here to new 4-month highs, and that's a pretty nice place to be. So we'll see if we can close out the month there. The Russell, this outperformance by the Russell recently is really a bullish sign since the start of February. That's a nice push we've seen. And again, that could be the gold miners or the metal miners, because all of these stocks have been beaten down into small caps, and the oil stocks. So if they're going to keep running here, this is quite bullish. I like to see that. And I think I'm just going to move out of here, and we're going to go. Let's briefly look at the Canadian market. And the main reason for that is just you could see that the Canadian market on a daily basis is already kind of making a wobble here in terms of momentum. And we're right up in the thick of things in terms of resistance. So the 16,000 level once again. So we'll just see if we have any more upthrust. There's a few more banks to report in Canada this week, and that's probably a big thing to watch. Looking at the TSX Weekly, another nice week again, up 1%. And I think, that was on the back of gold doing well, on the back of oil, Canadian oil doing okay. And then for the marijuana names, they were up about 1%, 1.5%. And the Canadian banks, Royal Bank reported Friday, and all of the banks seemed to have an okay day there. So I think the news wasn't too bearish. Let's just run down and start into the currencies. Again, the currencies are one area where I really want to focus. Maybe we should even annotate this one up. I think the big thing that I'm watching here for the US is, do we get this topping formation like this, or is this just like a horizontal resistance level, and when we break through it, we're going to pop in a big way? We don't really have the answer for that question. The PPO, again, made a lower low here, and if it rolled over and made a lower high, this would be, what's the right word? Disconcerting. So if this starts to roll over here, then, you know, perhaps that would give all of these commodities a run, and that's what they look like they want to do. But again, the oil stocks in the U.S. stopped going up this week. So perhaps it says the U.S. dollar is ready to push back higher. Looking at Martin Pring's Special K indicator on the US dollar, Martin talks about how this forms really nice trend lines, and when the Special K breaks, this is a pretty important indicator. So here we are sitting right at the trend line, and I think my next chart zooms in a bit here. Let me just check. No. I'll just go down to the bottom here and change the period. 10 years. And what we want to see here is this trend line on the US dollar. I can move all of these up a little bit, and a little bit here. So we're still in the decision mode. This is a daily chart. But if this was going to start to break to the high side, it would be very important to realize that the momentum is changing on the US dollar, and if it was going to break out to the high side, then we'd expect the euro to fall apart or fall down. Not fall apart, but fall down. And this is zoomed in on a daily view here, just going into less than 2 years. You got a left, a head, and a right. That's what I just drew on the other chart. But you've also really got a consolidation pattern after breaking out, and sometimes those just take longer to resolve and then need an upside push. The PPO indicator we had here looked like it was going to start breaking out to the top side, and now rolled over and paused. Again, until we get a final direction on this thing, it's really a 50-50 either way. If I was trading it, I don't know what I would pick for direction. I would definitely be cautious in small positions until we get an answer. Looking at the UUP, this is a simple little trend, and you can see on the PPO, we have this downtrend, and I just mentioned that, and it's trying to roll over here on a daily chart. But we do have this uptrend line still holding, and unless we started to break down below that, that would be something that would give us more of a clue as to which way the dollar wanted to go, and finally breaking either this uptrend or actually horizontal support and make new 4-month lows. For the euro, on the weekly chart, what we see here is this head and shoulders top, and then really trying to find support here going back for the last 5 months now, October, November, December, January, February. And if this is going to start to break, you know, we'd expect a big move down, and the PPO in this case is pointed down but hasn't crossed further down. So we just don't have a direction, and that's the point I'd like to make here. Until we get a feel for which way these currencies want to push, that's a bit of a problem. Now, I will say in October, when the euro started to break lower, that was a big deal, and that's also when the stock market topped end of September, right? So all of a sudden the euro was here and quickly moved all the way down to the bottom of the range. I think if it breaks the bottom of the range, we'd probably have more trouble with the overall equity markets. Here's the euro on a daily basis. You can just see how tight this wedge is getting. So as soon as we get a resolve one way or the other, that'll be very important to us. But, you know, the last 4 days just kind of hovered in here really tight, so we don't have a trend to work with. The Swedish krona, which I like to help me with the direction of the euro, I find it smaller and moves early. It's been pushing down for 3 weeks already, but I'm starting to get concerned because the euro hasn't followed it lower. Okay, looking at the British pound, this is a multi-year chart from 2012 to 2019, and you can see this uptrend we're trying to hold here. We're below the 65-week moving average. We've got an uptrend on the PPO, and we're trying to get back above zero. For the longest time, we talked about how the British pound PPO makes complex bottoms, not simple V bottoms or whatever. So anyway, we had that. Now we've pushed up. The real question is, do we roll over well under zero? And again, when you do that, that's typically a fast move to the low side. And so just keep watching this here, because if the British pound can't get back into positive territory, it could easily break this uptrend line. And we have that same condition on the Japanese yen. So we have the euro sitting on its trend line, the British pound on its trend line compared to the US dollar, and the yen. And so with the yen, what we see here is, trying to hold above its 65-week moving average. Didn't, and closed this week below it. Put in a little kind of a stall on the big move down we had the previous week. But nonetheless, we opened lower and closed lower. It looks to me like this wants to roll over and actually go negative. And if that was to go negative at zero level, that's always an important place on a chart. I think the next one shows this well. And what we see going back in 2012, when the yen broke below zero, or the PPO broke below zero for the yen, rallied back up and got to the zero level and then rolled back over. Look at the steepness of decline when this kind of positive area for the PPO became negative for a period of time. And we're sitting right now at this pennant. And again, if this breaks lower, so US dollar higher, euro lower, pound lower, yen lower, a soaring US dollar I think would be something to really watch for. And that would be one thing that would change all of my sentiment on the equity markets, is if all of a sudden the US dollar started to soar. I don't think that would be that positive for the equities. So here's Japan on a daily basis. And you could just see this chart is hugging the 65-day moving average, and conversely it stayed pretty much below it all the way down here through last year. So it peaked out at the end of March, moved down all the way into December, and then on the rally in December it finally changed direction. Here we are continuing to drift lower. So I'm trying to figure out which way this wants to go, but we're sitting right on this moving average. And you can see that the yen in general, or sorry, the Nikkei, when the Nikkei is rising, the yen is falling. And then here, the yen went for a big spike up and the Nikkei went for a big spike down. And then since that point, the yen has been falling and the Nikkei's been rising. So we had a pretty good push in the Nikkei this week. I think it was up 2%. So with that big move up, this continues to look good, but this blue line at 21,000 is an important level for us to be aware of. Just that was major support going back for a year. So if we just get above it for a couple of days and then fail, makes for a lot more deciphering of what's going to happen in Japan. I did mention on the Friday version of the Market Buzz, I went into the Japanese yen and how to look at the Nikkei in Japanese currency, so in the yen, and then how to look at it as EWJ and HEWJ, and just try to keep track of those three things. So hedged against the US dollar, unhedged against the US dollar, and then in the local currency, and see what's going on with the charts. If we start to see Japan change dramatically, it might be because of their GDP right now is at zero. So continue to keeping an eye open towards Asia, but again, the Shanghai chart's starting to move up aggressively. South Korea had a good week, Japan had a good week, so if those charts are going to continue to improve, that makes me a little bit more bullish on that scenario. Okay, continuing back onto the currencies, the Canadian dollar continues to run down here, and it, again, oil tracks the Canadian dollar pretty well. So if I just overlaid oil, Wrong place. If I overlaid oil, oh, I've got it there. I just have to turn on the opacity. And what you see is, the moves aren't exact, but for the most part, they follow each other pretty good. And in this period here, the Canadian dollar was weak. The price of crude continued to rally up, and then look what happened. It basically fell back and caught up with the Canadian dollar. So now crude is starting to move up, and so the Canadian dollar hasn't broken its trend line yet, but it's been moving up with crude, and the PPO has started to change and break out of this downtrend. So maybe crude is ready to go higher, and the Canadian dollar can go with it. So if that's the case, that was the kind of way we bottomed in 2016. So maybe we're starting the new commodity bull market. On a daily basis, this is the downtrend that's been going on for 18 months now. And as we watch, can we get through that? And again, it looked a lot smaller on the last chart, but you can just see we've been making a series of lower highs and lower lows. Our PPO is above zero, so if it rolls over here, we'd expect another leg down. If it can finally turn higher here, that would be a complete change. In all these other cases, the Canadian dollar just kind of rolled over and kept going lower. And here, if it got above, pulled back a couple of times, and then finally shot up, that might be the change we're looking for in trend. For the Australian dollar, same downtrend that we saw in Canada. This one's about 14 months long. But again, this downtrend on these commodity countries, I would expect to break to the upside. This is the price of copper here, and as copper starts to move, there's a pretty nice correlation. When the Aussie dollar was rising, so was copper. Copper topped out. We had this one weird spike in copper, and nothing else kind of followed with it. And anyway, it fell away. So we've been falling down for a while. Copper stabilized, so did the Aussie dollar, and now copper spiked. So I'm expecting the Aussie dollar to start to spike, but we haven't seen it yet. Okay, daily version of the Aussie. And you could just see we're trapped around this trading range here. This is pretty small, 70 to 73 cents over the last 3 or 4 months. And as we stay in this narrow range until we get a breakout one way or the other, just too hard to decide what it wants to do. Okay, one of the things I've been watching hard is the bond market. And what we see on the bond market is this rollover in momentum. Well, price is higher, so we've got a lower momentum but a higher price. Typically when that rolls over, that's worth paying attention to. So when we look back in 2012, this rolled over, and it wasn't that good of a clue of a market top or whatever. I think the stock market oscillated in 2012, and then in 2013, the stock market ran up while QE was going on. So I have trouble using this period in here, well, even all of this period in here, because it was a heavy QE period. But now it seems like we're at the top, and this looks like it wants to roll down now. Again, 3-month LIBOR kind of tracks the Fed 2-year rate. And so we're continuing to watch that to see which way LIBOR wants to go. Here is the junk bond market, and what we see on this, so when the PPO rolled over under zero, this was a pretty big clue. We had the same thing happen over here, and it was a very quick acceleration down. So again, when we see a market with the PPO turning down below zero, there's the potential there for a rapid price movement to the downside. And so what we're watching for on this junk bond is which direction does it want to go now that it's reached resistance. Well, it looks like it wants to get through, and we have a little bit more work to do here. If it all of a sudden started to stall just below zero again, we would be very careful for another fast move down, but it looks to me like it wants to go higher. Looking at the 7 to 10-year Treasury, this is just getting up to resistance level. So does this roll over again? And this is price. So when the price is rising, the bond yield is falling. And in this particular case, does it get through, or does it peak out kind of where it has in the last, 2015, 2016? Does it roll over right there and start falling back down again? The corporate bond market is still rallying here. Everything looks to be pointed higher. It made a higher high this week. So nothing, it's hard to argue that this is ready to roll over, but it does make me wonder based on the PPO. Okay, the 2-year is one of the charts that I mentioned a few weeks back. You know, there's some really nice indications here from 2000, and it was a relatively timely call. This fell down in May, and the stock market topped in March on the NASDAQ, but on September it retested the highs and then fell down. And here's 2000, and we see this market top out. In 2006, it topped out about July, and the stock market didn't top out until a year later. So it's not exactly a tight timing tool, but it is definitely saying to be cautious here because it's fallen out of the overbought zone. And now we've tried to rally a little bit after that. So if it was to do the same thing we did in 2006, 2007, then maybe that starts our leg down. Just don't have a feel yet. And this is a monthly. So we're below our moving average. And when we got below the moving averages before, after these cycle highs, it was a pretty good place to be aware of. In 2016, it was pretty much a false breakdown, but it's this overbought condition after being up here for over a year that makes me wonder if this doesn't need to just kind of come down a bit and then roll lower. And if that was the case, then I'd be a little bit worried about where the stock market wants to go. Okay, looking at the tips, Treasury inflation protected treasuries. What we see here is this downtrend on the black line, and in behind I've got gold and the yen. And we just don't have a match here as the yen is starting to drift lower and gold and the inflation protected trying to go higher. So keep watching and see which way this goes, but we're getting to the zero line. Does this roll over like 2017, or does this keep going through like it did back in 2016? Here's the TLT, and what we see here is a horizontal level at 122. And we've been stuck here for a year. So obviously if this continued to break higher, that would really surprise everybody. So watching that one closely. The BlackRock Muni Fund has a couple of things going on. The volume this week was extremely low, down here at 317,000 with a moving average of around 1 million. So really, really light. And when you got down here in 2017, here's July 2000 or maybe September 2017. What you see is this really started to roll over on low volume. I'm wondering if that's what's happening because we had low volume a couple of weeks ago, as mentioned here, and now we've had low volume again. Okay, let's get into the bonds themselves, the 10-year. And what we see on this chart is it continues to drip lower, but we're right at the full stochastic 50 level, and this is an 80-period full stochastic. But what you can see is when we're above 50, this is pretty bullish, and when we're not, this is bearish. And so we're right at that dividing line, and we want to watch which way this wants to break. The 5-year gives me caution because it keeps trying to bounce and failing here at this trend line. And again, much like that 2-year chart I showed earlier, I think if this 5-year is going to start breaking down and staying in a bear market here, this would be a bigger deal. So watch closely because if it turns up right away here, that would be very supportive of of yield, and price would fall. But if we don't get that bounce, I think it's a pretty critical place to be aware of the change in trend. So going back to the 2-year, here's the big picture. And you can see this 3% level we stalled there. We're now down in the 248 level. And I think the next chart, maybe it's a couple charts away. No, next chart zooms in on this price action. And what we see is we've broken the uptrend going back to mid-2016, and it's starting to roll over. Now, the PPO looks fine. And if it started to bounce right here, that would be a normal expectation, and then that would suggest that we're going to maintain our bond bull market for yield and bear market for price if this stays above the 40 on the RSI. So it's right at the deciding point, and if it turns down hard here, we need to be ready for that. Conversely, if it finds support there, that's probably bullish for the overall equities. Let's just quickly look at the spread chart one more time. And what we see on this spread chart is the 2, 3, and 5 are still below the 1 year. And again, they all pointed lower this week. So yield dropping, price rising gives me a little more concern. Let's head down into the commodities. And the point I want to make on the commodities is they had a big up week and are now above last month's high. And if we look at the weekly view, we can see this big push here to close above consolidation. So we had this flag pattern where we came up, ran, and then the next flag would probably take us up to this 40-week moving average. The PPO trend line is right here, and we're approaching it this week or next week. And as we approach that, we want to make sure we have enough thrust to keep going through very positively like we did back in here and get going all the way. If we don't, that would be a problem. So we just got to the 20-week moving average right here. You can just see the dotted line. If this all of a sudden was a breakout and then failed right at the 20-week, that's a concerning place on the chart. DBC, the total commodity ETF, you can see the breakout back at 1575, and now we've started to work our way higher. Very straightforward way to just play the whole commodity space. Looking at the individual charts, here's West Texas crude breaking out to higher highs. Nat gas trying to bounce off this major low that goes back to 2016. Looking at heating oil, it's well above its 10-week. Same thing with gasoline. Both of them are looking really promising, so that supports higher oil prices in my mind. Corn weak, soybeans not much. It bounced up a little bit, but really nothing, and wheat was down hard. Gold and silver, these charts just keep looking great. This gold chart continuing to climb, and the silver chart oscillated a little bit this week, but didn't make higher highs. So that's an area to be focused on. Just make sure they can continue to both climb. Copper had a surging week, up 5.5% as mentioned earlier, and the aluminum ETF not so much, just kind of stayed flat in the range. I'm not going to go through the commodity, the Goldman Sachs commodity indexes this week. So here's the marijuana life sciences, and again, just want to bring it up. So we have a left shoulder, a head, and a right shoulder if this event plays out. And what we're watching for is here is the momentum. And so as momentum is rolling over very close to zero after being below zero, if this was to start to fade in there, we'd expect this to drop quite quickly. And the full stochastics very close to turning over here, well at 80. So I would just say be cautious if you're holding those, expecting big gains, and then all of a sudden they don't show up. Just watch the chart action, because that tells us what investors are doing towards that. So here's coal, and what we see on coal, this $14 level is meaningful, and what we see on the steel ETF, it's starting to break to the upside and get above this horizontal support and resistance level. I find that very bullish. So keep watching those charts in there, both of those ETFs. You can either go look at what the ETF listings are and what stocks they hold, and that'll give you some ideas. Here's lithium. You can see this big downtrend here just getting broken this week, and the rare earth strategic metals also breaking above the 10-week last week and continuing to climb higher this week. So I continue to like the space. Both of these are looking really promising, and again with the big move in copper, perhaps it's all ready to move. Looking at the XLE Energy ETF, you can see that we rallied above this horizontal support and resistance layer and then just kind of stalled there. Now again, there's some other energy types in XLE like solar, so it's not a specific oil play, but it does have big oil in it. Here is a crack, which is the oil refiners ETF, or the integrated companies as well. We see huge volume on here for this week, and the problem we have is this is breaking down to new relative strength lows, and here we had a doji candle where we rallied up and closed back where we opened. And then lastly on here, you can see this horizontal support and resistance layer going back at, call it $30, and that's what we hit over here. So this would be a textbook case of getting back to support, now becomes resistance, and we bounce off it and then fall away. Don't have that planned out yet, but if that was what's to happen, then the weakness we saw in the oil stocks earlier or for the week could be rolling over into the refiners as well. Okay, here's FRAC, the ETF for unconventional oil reserves, and we don't have any kind of price action this week. It was down 1.3%, but basically held in range. And that's just the daily. So here's the weekly on crude, or sorry, the daily on crude. And as we break out, you know, we got above these prior two highs, so that was pretty important. We need to stay above this 55 level, I think, if we're going to continue our uptrend. So I wouldn't want to see it fall much below that. Okay, natural gas, let's just check out this chart a little bit. So this is the trading range to trade against. And again, if natural gas is going to start to bounce here, this would be a great place to get on board. And the big reason for it is, you know, 2 or 3 years of support from this level. So as we bounce here, just watch how high we can bounce. And one thing we want to make sure of is it really does get going. And so, you know, if it continues higher here, that would be enough of a base for me to get long natural gas with a relatively tight stop. Okay, this is the natural gas ETF, FCG, and you know, it's making lower highs compared to January, so that's not that bullish. And here's Cabot Oil and Gas, and it actually closed right back down at its 50-day moving average, and it's making lower highs here, so I'm a little bit concerned that it's not cooperating as well as I'd like to see it. We see the ratio here of the natural gas ETF outperforming natural gas, but without question this week it definitely broke through the trend line that was uptrending, and we need to watch that. If that's going to roll over, that might be a clue for more weakness in the natural gas stocks. It's hard to have natural gas only. Lots of companies you'll have natural gas and then you'll get condensate or oil with it. You can have gas only reservoirs, but as the gas comes out of the ground, you get some oil or condensate with it. The problem when you have oil is oil will always produce gas with it, and so these companies are never one or the other. You get a kind of a blend off of what they make or produce. The uranium ETF is trying to push to higher highs here, and again another utility doing really well, because that one looks at the power generation companies, which are typically utilities, not the uranium miners. And this is the uranium miners, but this ETF also has some gold producers in it, like Barrick and that kind of stuff. So as you see, this breakout above, and then we've done nothing for the rest of February. So this continues to be really frustrating, because it finally broke through a 1-year downtrend and then did nothing. This is the weekly chart of the chart I just showed you, and you can see again trying to get going but hasn't really been able to. And the PPO, if it just rises to 0 and then starts to turn back down, that's a bigger problem for us as well. Copper, what a beautiful bar on the end here, breaking above the last 6 months zone. So that's very bullish, and we see that throughout the copper complex and the steel complex. A lot of the industrial metals really roared with copper this week, and it could be because of positive news on the U.S.-China negotiations now. The news is fits and starts here, but the charts are definitely trying to give us an uptrend, and as it's breaking out of the base, that's the time to own it, so you can keep your risk relatively low by placing your stop very, very close. You can see copper, the PPO is right at 0. We need to see that continue We don't want it to see it stall like it did in 2016 and just jog sideways for 6 months. Looking at the steel ETF, what we see here is breaking through, the coming out of this consolidation and now pushing up. And then once it pushed up, it got back to this support and resistance line. And we really need to see it get through that. And it's also through the 40-week moving average right here. If the relative strength can break out, that should help as well. And we did see that the price move is getting fast enough to actually pick up speed compared to some of the other ETFs out there. Just better than 50% of them now in terms of speed of price, so call it middle of the pack. And then looking at the downtrend on the PPO, it has been broken, so I'm expecting further upside here. Let me just go. Okay, so let's get into gold. And what we see on the gold chart, again, we're up at this resistance level, call it 127 to 130, and we really need to get through that GLD. What we've been noticing for the last 3 or 4 weeks is the histogram has been shrinking slightly. So again, if this was going to roll over, that would be a big concern, because that's typically, you can just see for the last 5 years, it's about this much momentum and then it rolls over and just kind of fails. Now, you can call this an uptrend, but it's really choppy and you didn't make a lot of money trying to stay in it, that's for sure. This area here this chart concerns me a lot. This is the ratio of the gold miners compared to gold. And you can see it's right at the trend line. And if we can't break through this multi-year trend line, I think that's a bigger issue. Because typically GLD, when GDX outperforms GLD, so the miners outperform the metal, you're in an uptrend, and when that stops, that would be a problem. And so back here in 2018, when it stalled at this level, down she went. And here we are building the same sort of uptrend, and it looks like it could potentially roll over and cause more problems for us. So not really good news on that front. On the silver front, same thing here. We're kind of stuck at these prior highs. Doesn't mean we're going lower. It just might mean we need a little bit more time to consolidate our gains. But I'm getting cautious on the precious metals just until we can start to see them continue. But the strong names are still climbing. So here's lumber, and this rollover in lumber is very concerning. If the PPO was to roll over below zero, that's typically when we see fast downside acceleration. So if you're invested in the lumber related stocks here, just be aware of this sort of pinnacle action here with the PPO below zero, and then all of a sudden it whooshes to the downside. So with that, I want to thank you for taking the time to join me. I know I've covered off quite a bit here. Let's go back and just look at the PowerPoint. Currencies are still a big focus. Once we get the decision on the dollar, especially from the euro, the yen, and the pound, well, even the Canadian dollar, there should be some big clues there. So I would just say don't take your eyes off those. That is an important area of the market. The breadth is still telling us it's a big bull market, and commodities had a big week. Continue to be involved with the oils and the precious metals, but if they start to break down, don't ride that trend lower. And then checking in on steel and lithium, those charts look great and look like they're ready to run. So thanks for taking the time to join me. Have a great week trading, and we'll talk to you soon. Thanks. Bye-bye.